This is Jordan Moorhead, and this is the Austin Real Estate Investing Podcast. Today we have Sapan Talati on, and he's going to tell us all about what they're up to at JT Capital and how they're finding great deals with risk-adjusted returns right now, so you don't lose your shirt. Hey, Sapan, how are you?
Well, thanks, Jordan. How are you? Thanks for having me.
Doing great. And I know we talked a little bit before, so I'm really excited to talk about some of the subjects we've got coming here. But before we get started, what's your favorite restaurant in Austin?
That's a good one. So I reside out here in Southern California. I visit Austin often. We're based out of Austin, and one of them's La Margarita Restaurante. It's up in Round Rock. I'm a Tex-Mex fan, so I've got a little bit of bias there.
We've got some good Tex-Mex here in Austin. So
You do.
you'll find plenty of good Tex-Mex places here, but I definitely got a good list going if you ever need it.
Would love it.
Sapan, real quick, who are you and how are you involved in real estate investing?
Sure. I'm a co-founder here at JT Capital. I've been involved in the industry for about 15, 18 years now at this point. Transacted well over $1 billion, maybe closer to $2 billion in terms of just multifamily real estate throughout my career. We focus on, I want to say value add, but it's not just value add, really it's repositioning good quality assets, institutional quality assets in good locations. Our focus is predominantly Florida and Austin.
Oh, cool. That's awesome. Both great markets. What drew you to Austin? Why do you guys choose Austin?
Well, we've loved Austin for a while. The demographics, just focusing on the changing of the environment, the growth that's been going on there, going back almost 15 years. It's been on the radar. And then having two partners that reside in Austin really made probably made more sense at that point. Almost couldn't get better in terms of boots on the ground at that point. And it took some time of really locating deals. We've underwritten many. I couldn't even put a number of deals over there, and the numbers are a little tough sometimes to find that risk-adjusted return. But again, it's trying to find that diamond in the rough, and you tend to find those every now and then as long as you keep putting yourself in position to get those opportunities. So Austin's really been a focal area, largely because of our presence there. And then Florida, of course, is kind of our bread and butter outside of that. Other areas in Texas we've been looking into, Houston, Dallas, we've largely exited. So we're familiar with Texas, just very selective.
Yeah, I love that. So that brings up a question for me.
Mm-hmm.
Why have you gotten out of Dallas at this point?
Had more to do with resource, in the sense of just where we're based out of. As we're focusing more on operations, we wanted to make sure we had the ability to continue to excel on the operational front. We're seeing when we're acquiring deals, for example, we're just seeing a lot of shifting of personnel. Payroll costs have increased. For us, it's just, okay, how can we control certain costs? How can we pull in other personnel if we need to, as folks are moving from one asset to another, and especially be able to maintain that consistency in terms of how we operate and what we want to deliver internally. Obviously, all of these have an impact on the overall end result of the asset performance. But for example, if we were to have a community manager leave for whatever reason, we wanted to have the ability of just bringing in another community manager, hit that ground running. They're already familiar with the asset, familiar with how our expectations are, familiar with the communication, the platforms we utilize. And so that was a big piece for us. The other part to it is we found it to be more advantageous for us on the acquisition side, to really laser focus on a few selective markets, where we can understand that market, the movement, far more than just looking at a CoStar report and data points, but rather there's familiarity with what's going on locally. Having access to, I would say, kind of on the local town level, knowing, different permits, what's going on in terms of development, and not just real estate specific to residential and commercial multifamily, but also just on the retail side. Mm-hmm. And we felt that's been impactful with how we've been looking at deals. And what I'm trying to get at is not everything is going to be a data point, but part of that is also just being able to qualitatively understand what's going on in that submarket. So that's been helpful. For example, knowing that there may be a Costco going up 6 months from now and knowing how long that takes to build, may have an impact on the traffic, especially if it's an area that's somewhat up and coming, not far out from maybe where we're currently located, or we've been looking at deals, and having an understanding how that's going to impact, rent, because maybe there's going to be other supporting businesses that are possibly permitted or going through the permit process. And so those are things that we find, or variables, I should say, that we find important for a group of our size, where we feel like that's enough of a difference maker, just to remain and be competitive, and look at it as a competitive advantage.
Yeah, and I think that's so important too. A lot of people, when you're just looking for the best return in the best market, like you just
Hmm.
mentioned, you don't know when a Costco's going in that specific area if you're not paying attention, or you don't know when, let's say in Austin, we've got Kyle just south of Austin, and
Hmm.
Snooze, the breakfast place, it's based out of Denver, that's real popular around the country, is putting a Snooze in Kyle. And there's a Costco that just
Hmm.
opened in Kyle. There's another Costco that's opening in Georgetown here soon. Like, if you know that stuff and you've got your hand on the market or pulse on the
Right.
market, you can make better purchases and better decisions. And it's hard to do when you're spread out all over the place.
Correct. Yeah, no, absolutely correct. And it impacts your underwriting, because looking at other comps and just underwriting off comps, that's a snapshot in time. But how do
Mhm.
you project forward looking, right? And sure, we can take market fundamentals and local economics, and like we will, and we of course do, but to have confidence in where we feel occupancy could be as a result of what's going on around locally, understanding what your demographic is. Another example is, we look at migration patterns, understanding where certain maybe ethnic groups tend to prefer to reside, and part of that, and the example I'm going to use, we're looking at a submarket. We understand there's a larger, I would say, subgroup of Puerto Ricans there. In general, they tend to reside with family, with grandparents, and so like these 4-bedroom units make more sense in that particular zip code, where it may not make sense in many other locations. And so that can become somewhat of an attractive asset, because we understand what's going on locally in that demographic on a cultural basis. So we can price that in versus, this has 5 or 7% of the asset has 4 bedrooms. This may or may not work for us. And so that kind of comes back to, how do we take what we're looking at? How does that translate into the overall business plan? And then can we execute? And it has to be a little bit more than just the data points. And so being spread out for us didn't make sense. And we found this to be quite a successful model for us. We started doing this right before COVID, where we started really laser focusing on 2 or 3 different specific submarkets in Florida, and then just Austin.
Nice. So Sapan, what initially got you interested in real estate investing? Because everybody starts somewhere, and a lot of people do make a jump into bigger multifamily quicker than others, but
Right.
not everybody does.
Sure. Yeah, for me, it's just been my career trajectory. I used to be in management consulting. My clients were in the real estate side, commercial real estate. So it was just a natural shoe-in, where a lot of my training on the strategy and operation side was some of these larger portfolios that some private equity firms had. And I just kind of grew up in that environment from there.
Nice. It's a good place to start.
Sure.
So I know you mentioned earlier, like, it helps you to be focused in one market from a
Mhm.
asset management and a management perspective. And actually, believe
Mhm.
it's funny you mentioned that, because I'm in 2 deals where we just had to
Mhm.
change management companies because the management companies are having such trouble staffing right now. And I
Mhm.
could see where it would be an advantage to be in a specific market. So are you seeing that a lot with management companies you're using, where they're having trouble staffing, or how does it help you to be concentrated in one market?
Sure. Sure. We're seeing that. We ourselves aren't necessarily experiencing that, but we're seeing that. Just, we tend to talk to other operators locally. We're always looking to buy another deal, and that question comes up. And, a lot of times the local, the on-site team, they tend to share more information than maybe other folks would like for to be shared. But we do hear that. I think it comes down to relationships. We've got, I can speak for us, we've got good relationships with our team, where we've had asset managers or on-site asset management community managers want to stay on board with us or follow us. And so I think for us, it's a little different in the sense that we've just been very relational. Sure, we've lost a few, but it's been just as easy for us to replace them because we've got that, the relationship with some other folks that we may have worked with previously that are elsewhere.
Are you
But
vertically
it is a
integrated?
challenge.
Are
No,
you?
we're not.
Okay.
So we work with a couple different third-party property management companies. That's purely by design in the sense that the vertical integration makes sense. We just don't have that scale where we'd like to be able to do that today. I think the scale really depends on what type of assets you're buying. For some folks that could be anywhere 4,000, 5,000 doors. For others, it could be over 7,000, 8,000 doors. It really just depends on your model. Depends on how spread out you are or how concentrated you are, what type of assets you're buying. Are these largely C class? Are you buying A class? So there's just kind of give you some extremes. Really tough to say what that magic number is.
Yeah. Well, I'm sure the rents have a lot to do with it too. Can you pay somebody to be
Sure.
just, I would not want to be vertically integrated with management company ever, but I'm sure at some point it makes sense.
Right.
So, you're also in Florida, which
Mm-hmm.
the first thing I think about when I think about Florida right now is insurance.
Yes.
How's that affected you? Have insurance costs gone way up?
They have gone up quite a bit, as expected, but not to the degree that we're seeing. We did expect insurance costs to go up. We haven't expected them to go up as high as anywhere from 70 to 100% on some of the assets. We've looked at some deals that we liked quite a bit. And then once we looked at the insurance, we ended up having to walk away from the deal well ahead of before we made an offer. Just to kind of give you some numbers, we've seen deals ranging anywhere from $2,000 upwards to $3,000 a door on the insurance front. These are mostly on the coastal areas. And then of course it comes down to the stick build versus the concrete block. So there'll be some savings there. But I think the biggest challenge there is most carriers, if not all, are not giving you bindable quotes. So you very well could get into a contract and you've got this quote, but it's not really a true quote, until it's bindable, and that might take some time, into your due diligence period. Where what do you do? How do you navigate around that? So those are some challenges there. I also recognize this is probably just a snapshot in time type conversation. That may change. I expect it to change. We're not expecting insurance to come back to earth anytime soon. So we've just got to live in that environment. So it's not just that rising interest rate environment, but we've got the increase in insurance costs, and it varies. We're seeing it a little bit cheaper out inland. Some other challenges that really hasn't been discussed. We talk about the cost of it, but then your deductibles also increased 2%. It's just not a thing that's offered today. We're seeing it, much higher than 2%. So those are some other things that you have to take into account when you're looking at an asset and your overall returns, what they look like.
Yeah, and I think in Texas we have our own
Mm-hmm.
intricacies. We've got property taxes which have shot up. It sounds
Right.
like they're going to go down. I don't know if you saw the
Mm-hmm.
Texas House and Senate seem to have agreed on a property
Right.
tax reduction bill that should help everybody. I don't know the specifics yet because it's not passed.
Yeah.
But hopefully this week we learn more. And just for this week, for everybody listening, we're recording this on July 12th. Just the news just came out in the last 2 days that they had agreed, but they have not signed a property tax relief bill yet here in Texas.
Yeah, and the impact of that will be really interesting. Similarly, they've passed legislation in Florida earlier this year related to insurance as well. But we're not expecting that to have a significant, I would say observable change, at least this year, but probably possibly going into next year. These things just take some time, and for the time being, it's an industry-wide problem. So it makes it in a different way or unique sense. I don't want to say easier to navigate, but the conversations are a bit easier to have because it's not a one-off.
Oh, yeah. So for people listening, you said 2 to 3,000 a unit is starting to be the standard in Florida. What
For coastal, select
coastal?
coastal, the further south you're going, yeah, and this tends to be more in the areas that have a higher probability for and
Hurricane.
so let's say
Yeah.
a storm or hurricane, especially as we hit hurricane season, which we're currently in. And that's the other thing, the cost is obviously quoted a little bit higher during hurricane season, could increase significantly more if there's a named storm, whether or not it's going towards the asset you're interested in. Those are some other things that just unfortunately play a role. But it's interesting times because same thing, you got these sellers that may want to sell or not want to sell. You try to adjust pricing accordingly, but they also have to face the renewal on the insurance as well. And so there's some thought and decisions and analysis that need to be had on both sides, whether you're a buyer or a seller.
Yeah. And for reference, what are you seeing or what have you seen recently for cost per unit in Austin or in the Central Texas area?
I'd have to check on that one. I know we just did the renewal on that, but I don't want to give you the wrong number.
Okay. So just
Yeah.
average or ballpark, would it be half, 2/3?
I
Like
would
that?
say it's about half.
About half.
We've seen some increases over there as well.
Oh, yeah.
But
Yeah.
it also depends on same thing, the age, the location, and so the impact hasn't been as significant. One of the driving forces that we've seen in Florida, I think, has a lot to do with some of these past storms. We've seen the increase in costs, right, for building or construction, I should say. So you want to cover that. But what I thought was a unique statistic, and I think it could be a variable, is if you look at the number of this is kind of comical in a way, but the number of lawsuits that have occurred on single family homes
Mhm.
across the country. And don't quote me on this, but somewhere in this range, somewhere around like the upper 80% range of those lawsuits are in Florida on single family homes. And so that's where it's kind of, I think somewhat of a legislation problem, or why they've enacted some new legislation to address that. But those are some factors that end up, coming back to all of us in terms of when we're paying our premium, because they've got to recoup some of those costs.
So is that a
But
lawsuit in like a seller didn't disclose damage or something like that, or?
I don't know the details behind that. These are just data points I was
Okay.
reading or trying to really understand what's kind of behind the insurance costs having gone up quite a bit. And that was one of the things that was mentioned, is that they're seeing just these lawsuits. And I don't know whether that's a function of folks had maybe filed some claims and they were denied, and then therefore it ended up landing there, and were those claims filed because of a result of some of the storms that we've seen, or is it something entirely different? But I just thought it was fascinating to just see such a large number in one state, relative to the country. And so my thought on that was, okay, well, this might be one of the reasons we're seeing a significant increase specifically to Florida, especially along the coast. We've seen some of those increases out in Houston as well.
Oh, yeah.
Not nearly as much, in Austin.
Yeah. We're a good bit from the coast. We're not that far, but 2.5, 3 hours.
Right.
So yeah, that's really interesting. I think there's so many factors. And I think, due diligence is so important, and
Mm-hmm.
doing the right due diligence and making sure you have the right
Yeah.
cost estimated. And anybody in any level of real estate investing can learn a lot from that. Do
Right.
you have a big mistake that you've made investing in real estate, Sapan, that you'd say, hey, don't do this? So I know for me, and why I brought up the due diligence pieces, it was due
Sure.
diligence. I didn't do the
Mm-hmm.
right due diligence on a property, and I should have gotten a lot more in credit on it, or I should have passed.
I think it is maybe something that maybe just can't like a cop out, but really it's just something like none of us saw. In hindsight, I wish we had purchased lower rate caps on a couple of our deals.
Yeah.
we're not in
Yeah.
trouble. I just think it would have been um, significantly impactful when these rate caps were far cheaper than they are today. And the thought is just having that foresight, foresight. And again, very few people, if any, projected where we would be today. Our
Nobody I
thought,
know.
yeah, nobody I know either. We were expecting rates to go up a little bit further once we got into it, but before all of this started, we were still. We're risk averse, so our rate caps we were buying around 200 basis points anyway. So we were, even if the lender had required 300 or 350 bips, we were still looking at 200 at the time. So for us, it's been a nice I'd say situation, but at the same time, it's just, hey, we should have bought 50 basis points if we could have. I'd say that's probably one of the, I think, learning lessons or whatnot is when it's just kind of looking at some of these extremes a little bit more with a little more awareness, and partly because we've been through, if you want to call it black swan events during COVID, we seem to have some more of these events, far more than we've probably seen historically. Like 30, 40 years ago, we're talking about the high interest rates and kind of like the 80s. We had one recession, early 90s with 98, 03, 07, 08. And a lot of the normalcy was, it's easy to just study that history, but what we've seen the last, 14 years where we've had significant cap compression, we've had, interest rates coming down significantly to where you go out for a loan and they have a floor written in because the interest rates are lower than the floor. That's just stuff we've never really, seen, at least in our lifetime. And then you follow it up with these, 30, 40% rental increases that we were seeing in 2021, early part of 2022. Also something entirely unique. And so
Especially in
I feel
Florida.
now
The rents
we're
were
seeing a lot
yeah.
of uniqueness that it's just, hey, let's take a look at this with an extra, an extra eye, just to make sure we're, for us, it's like we're that risk averse group, and so it's well worth it. It may or may not make sense for everybody, but that's for us is one of the learning lessons, at least for our model.
Yeah. So Sapan, did you get into the industry in 08, if I'm doing my math right? Or were you right
Yeah,
around there? Okay, cool.
yeah, right around there, a little bit before that, 06. From the consulting environment. So that's correct.
So you saw what happened with commercial real estate in 08, which wasn't bad in most cases.
Yeah,
It was
right.
actually good, right, compared to residential. Um,
Correct. Yeah.
so with the rate caps, and I particularly I think sensitive to the term right now. I'm an LP in a couple deals with
Mm-hmm.
rate caps right now. One of them just had a capital call.
Okay.
The rate, I think the rate we went in at was around 3. The rate cap was like you said, 200 basis points. It
Mm-hmm.
got there real quick, and then
Yeah.
I want to say the rate cap expired. Where were
Mm-hmm.
you at, and what'd you go in at? What was the rate cap up to, and where's it at now?
Sure. The one I'm thinking off the top of my head, we closed on a deal last year, July. We got in around 3.5, 365, 365
Wow.
bips on the rate. We actually bought a 50 basis point rate cap, and so we locked in pretty low. I think that was unique because when we were going in, we knew at that point it was pretty well known, right? Rates are going to continue to go up.
Yeah.
And so then it was okay. What kind of lender do we want to work with? And we had decided to go with a balance sheet lender, largely because they are more likely to retain the spread and not change that on you as you're getting closer to closing. We've seen a number of GPs where their spread, kind of changed on them, in that final week or maybe the 11th hour, and it changes your numbers and, it caused a lot of unnecessary stress. So that was one of the things we had done, was really focus on what kind of lender we're working with. We felt pretty strong that the rates were going to continue to go up because we weren't seeing anything in the news cycle that really led us to feel confident that there's an end in sight. And again, we don't have a crystal ball, but we just didn't feel confident or nor comfortable. So we had decided to pay the premium for the 50 basis point. So we were already in the money at that point. And, in hindsight, that was something we're pleased with. The deal before that we had done, our rates were, let's say, around 262 bips. And that's the one we did with 200 rate cap, or basis point rate cap on that. So we've been fortunate that some of the levers we pulled have turned out to be fine. But that being said, it would have been nicer if we could have even come in a little bit earlier. The focus that we've been doing on ours, because we recognize we're going to at some point come to a place where either we need to refinance this into fixed rate, even though it feels like fixed rate with the rate caps, or look at other options. Is really, are we hitting our pro forma? Are we hitting the numbers that we had expected? Because those are the things we can control, right? We can control our revenue, we can control the expenses, and really just dial in on that. Make sure that we're operating, as we expected, and executing on our renovation plans, executing on operations as a whole. Currently in rent preservation mode, especially as we're seeing softening of the rental markets. Keeping a keen eye on new deliveries, because that will then at some point further soften the market. So keeping a pulse on those things, and not really as concerned where the market's going in terms of interest rates, because we've got that rate cap kicked in as it relates specifically to the assets we're holding. But we're really focusing on making sure we've got options available as we get closer towards a terminal point, because we don't want to ever be a seller due to the fact that we have to sell.
For
we want to
seller,
be a seller.
yeah.
Yeah, exactly, because it makes sense to sell. And so that's really how we're making sure we position ourselves. So we're not looking at a sale when it's 6 months before maybe terminal point on certain things, but rather just continuously looking at this every quarter. Have any of the loan programs changed? Has there been any changes in maybe the spread? Are there new things available to us as borrowers? How are the covenants currently being structured? Is there more flexibility in some of these covenants that might make that loan more attractive to us, or is it adverse? So these are things we want to continue to keep a pulse on, because it may or may not be applicable today, but if we're understanding the trend of where we were and where we're going, it makes it a lot easier to make those decisions, because they're not just decisions that we're shooting from the hip and saying, guys, we've got to do something here, and what's on the menu, versus, okay, we understand what's been going on. So now might be a good time, because we're seeing, certain indicators that suggest this could become worse, or we're seeing indicators that this could become better. Similarly, we put a 5-year fixed rate interest only debt on one of our deals. We refied into it. We feel that interest rates will somewhat come down than where they were about 6 months ago at that time. And that's given us optionality that, this may be a little bit of a longer hold than 5 years, but we don't want to be stuck in a 10-year IO with today's interest rates. So we figured we'd do another refi down the road. So it's just taking that approach, that mindset, to what works specific to, that asset and the business plan that you had in mind for that asset.
Yeah, no, that makes a whole lot of sense. It's just so hard to predict any of that stuff, where a rate's going to be. Like you
Absolutely.
said, nobody had any idea they were going to go up this much this fast.
Correct.
And it's easy, people that aren't as involved in the industry, and I'm not saying I'm an LP in a few deals, and I did my due diligence thinking there's no way they're going to go up that much, but it's easy for other
Sure.
people to say, how could you not have predicted that? And nobody did. So it's just unfair to talk about it like everybody should have known type of thing. Sapan, if you had to start over today, and I know you started in the commercial side anyway, if you had to start over today, is there anything you'd do differently?
That's a good question. I think if I had to start over, I would definitely start through working at a large institution. I feel that some of the skills you acquire in observing how certain I would say businesses are structured makes a lot of sense. I've always felt consulting in a way, like working at a management consulting shop, for example, is somewhat of a shortcut. When I say shortcut, I don't mean that in a negative way, but really you just get a lot of different experience in a lot of different areas, and you can really focus on a particular industry. So by the time you are in your late 20s, you've got, I feel, almost double that experience, because you're working with C-suite individuals. You're working, in an environment that has a lot of expectations, for deliveries and deliverables. But I think it also depends on what you really want out of that career, because there's a lot of folks who are wanting to get in and they want more of that lifestyle. They don't want to maybe grow a massive portfolio, but maybe they want to do a deal a year. For that, I'd just say, honestly, it'd be, spend some time finding somebody you can latch on to that's willing to mentor you and help you and maybe work together with. I've heard from some folks, they've, tried to underwrite an intern for well-known groups out there, and that's helped them quite a bit. So I think it just depends partly on what you really want out of your career, where you want to be. So that would probably be my answer to that.
Yeah, what are your goals are? Where are you trying to go? So what are your goals?
Right.
What are your long-term goals, and what's your vision for real estate investing for yourself, for the company?
Yeah, no, thank you. We're living our long-term goal today. We just want to continue growing our business, acquire more good deals. We don't want to do too fast, so we like to sleep well at night. We never feel pressured to buy a deal just to buy a deal. We haven't bought anything this year. We're sitting on a lot of dry powder. We've been underwriting and looking at deals to keep a pulse on the market. We're in that mindset that we may not do a deal this year, even though we're only in July. We feel that we're getting into a point where there's going to be distressed opportunities. When we say distressed, it's not like a true distress. We just think that there's going to be groups out there that have some financial constraints or strain, just due to the current loan that they may have, or expiring rate caps. Could be an expiring bridge loan, or maybe the insurance renewal is not going to work out for them. So we're trying to keep up with that. We've got a lot of dialogue going on with some groups that are kind of approaching that. So we're patiently waiting. We're starting to see some more transactional, I would say, indicators where the volume will start to pick up a little bit more, but really not expecting a whole lot, until next year. But in terms of long-term goal, it's just acquiring more deals similar to the ones we've been buying, institutional quality deals that are, a few years recently built for merchant builders on to, within the last 15, 20 years, in great locations.
Okay, so you're Class A and Class B stuff in good locations.
Correct.
Okay,
Yep,
cool.
that's correct.
Yeah, and I think everybody is waiting to see what happens right now. And are you seeing that the cap rates are still a little bit below the debt that you can get right now on some of these stuff?
They're right around there, depending on where exactly you're looking. It could be slightly above, or it could be slightly below. So it's tough to really say, exactly where it's at.
Well, yeah,
if you're buying
every market and sub-market is different.
Yeah, every market's a little different. The assumable debt right now, you can get more aggressive on. We've got a deal that we've put out on market. We're selling that, sub 5 cap. And we're able to get aggressive on it because of the current interest rate on that, the fixed rate. If it's free and clear, we would have been selling it a little bit at a higher cap rate. And so it just depends on the deal specifics, and then where you're at. And then the other part to it is, what kind of interest rates are you getting? Different groups can go to the same lender, but depending on, their overall portfolio, the REO schedule, depending on, a few other factors, right? That interest rate will be different, from group to group, even though you got the same lender. So it's kind of tough. I think, it really just goes back to what's your hold period in a way. Are you looking at 3 to 5 years, 5 to 7, 7+? What kind of debt are you going to put on the deal? Are you looking to go HUD on this? So some of those things are going to make a difference as to, is this a deal that works for us or not? one thing that we're very keen on is to make sure we're not looking at that negative leverage either. We just don't feel comfortable doing that today. So that's and one of the other reasons why it's been tough to find a deal that just makes sense.
Oh, I bet. Can you do HUD debt on, because that's like a 40-year debt, right?
30 years, yeah.
30? I don't
40,
know where I
30
have
or 40. Yeah, I know it's typically like the 10-year prepay, and after that, you don't have a prepay. I mean, it could be part of a strategy. It works if you've got LPs that are looking to stay in a deal longer term. We've got LPs that prefer that. So for us, that makes sense on select opportunities, but it doesn't always make sense to do that.
Well, yeah, I think a lot of people want to keep the money moving, but a lot of people just want to sit and collect their income, collect their cash flow.
Correct. Yeah, especially if you've got deals right now that are cash flowing nicely. They just want to continue doing that. The value of the asset at that point may or may not matter. That cash flows continue to increase organically, closer to double digits, and in your, along the way, you've been able to cash out some of the principal. Those types of deals are great. But it also depends on the LPs.
Yeah, preferences, probably age too, what you're doing.
Correct. Yeah, and if you're doing mandates, in the original investment that require a certain selling point or like a deadline.
That would, I feel like that would be just a bad spot. You have to sell at a certain time.
Right.
Be sketchy. Sapan, do you have a favorite business or mindset book that you like to recommend to people?
A favorite business?
Business or mindset, could be either one.
I think the mindset is probably the most important. The business is always evolving, changing, that landscape's changing. I think the ones that we've seen, like those larger groups that have been successful for many years, the ones that are able to adapt and, latch on to new technology, not fall in love with any one particular technology. Otherwise you kind of go that route of, thinking like BlackBerry, for example, right? You just become an aged dinosaur and you end up having to shift that business model into security, cell phone security or whatever they're doing now, something related to that. So I think it's more of a mindset where I always just say, don't fall in love with any particular technology. That's what's going to continue to change, but just always be learning, be a student to your craft, because these things are changing quicker. The new thing now is AI and AI technology, and how can we implement that? I think that's stuff people should be learning how to utilize. There's a lot of new platforms that are using that on their backbone. So just have awareness of that, whether or not you're tech savvy. But I think it's worth just being a student to your craft, and that's like that mindset of go get it done.
What are the top 2 ways you're seeing AI implemented in your business?
Sure. Well, I would say one is definitely on the underwriting side. That's been around for some time. It's definitely picked up a lot more steam recently, and there's a number of platforms out there that are doing it slightly different, but where you can literally just drag and drop, T12s, rent roll, and it'll just spit out underwriting based on things that like parameters you've set in there, like preset parameters. Am I comfortable with relying on AI technology to do our underwriting? No, not at all. We do use it more so for cleaning up the rent roll, giving us different looks, almost like a pivot table, but getting you the look you want. So it just saves us a lot of time in terms of just cleaning it up, organizing it. But at the end of the day, we still do all of our own underwriting. I just don't feel confident enough that we're there yet.
So how do you get AI to clean up the rent roll? I really want to dig into that. So underwriting, I hate underwriting. I'm trying to underwrite some smaller commercial deals right now. It's my least favorite thing to do. Anything I can do to help.
Right. I mean, it's tough, right? How do you rely on AI to pick the comps for you? As one example. Like they make suggested comps, and I think that just goes back to, I've never been a fan of within a 1 mile radius and 3 mile radius, because as you and I both know, it's never a proper circle. It could be the next 2 blocks over or terrible, and everything this way is great. And so if you do a radius, you're capturing, just bad data that's going in. And so, and then the other part's like just the amenities, right? Different assets have different amenities, so you've got to take that into consideration. But yeah, what I like a lot, sometimes we get these rent rolls where each unit's got 5 different rows going across, and I don't want to see it in 5 rows. I just want to see it in 1 row. So it'll help clean that up. I want to see trend lines. I want to see the rents that are expiring, how many units are expiring, like, the leases, I should say, by month. And I want to see that bar graph. Just kind of gives me an idea what that bell-shaped curve looks like. So when we're looking at underwriting it, are we doing all 12-month leases? Are we going to have to adjust some of these leases on the renewals so we can get that optimal curve that we'd like to see, where we've got more leases during peak season to be, to fulfill. So there's these like charts and graphs that it's a lot quicker if I can get that all done without having to do the inputs and manipulate the data to kind of get those things. So that's what we use the AI for. I don't know if it's called true AI, because there's automation already out there, but that's just what we've been, utilizing, so far today. There are companies out there that are doing it a little bit further. And I haven't spent a whole lot of time learning about it just yet. I think it's fascinating, but on the asset management side, that's where I think we've been spending some more time, and that's the area that I myself haven't been, but I know the team has been, and that's just how are we structuring these leases. Also, where can we lower or save operational costs and streamline that? So we've been really focused on lowering expenses, with some of this that's now available to us, and probably offline I'll have to find some tools that we've been using, and I can send over your way.
Yeah, I think, what we're seeing now too, compared to what we'll see a year from now, is just going to be night and day. If you and I talked in
Oh,
next July, I'm sure you'd be using a
right.
lot more for a lot different.
Sure. I can see it as a prospective renter. You've got these chat boxes, which are going to have so much more to offer, right? You can just start chatting, and it's going to be pulling data from, the assets, data stuff, or whatever, the data warehouse specific to the asset. We're almost, it's like talking to a leasing consultant after hours. I can see a lot of things that can happen and transform our industry, which is pretty neat.
Yeah, it's gonna be pretty cool here in the next year or 2. Well, probably 6 months.
Yeah. Oh yeah.
Cool. Sapan, what is the best way to people to get a hold of you and your company?
Sure. I would say the best way is just go to our website, just jtcapitalgroup.com. If you try and get a hold of me specifically, I recently started Twitter, just at Sapan Talati, or you can email me, sapan@jtcapitalgroup.com.
And on Twitter, you at Sapan Talati, all one word?
All one word.
All right. Interesting enough. Twitter actually has a really good real estate Twitter following, or Twitter sphere, whatever you want to call it.
Yes.
Yeah, it does. Awesome.
It's got a lot of great people on there and a lot of good info. Folks out there listening, watching this, if you're not on there, you don't have to contribute. You can even be a lurker, but there's lots of good nuggets of information out there.
Yeah, just watch. Awesome. So make sure to follow at Sapan Talati on Twitter, at Jordan_Moorhead on Twitter, I think, and Instagram. And Sapan, we'll put JT Capital, all your links and everything into the show notes here, so everybody can just find your information there.
Sure. Thank you.
All right. Thank you so much for coming on, Sapan. It was great talking to you, and have a great day here.
Thank you. Appreciate it, Jordan. You too.
All right.